If you've been watching the silver charts over the last few weeks, you know we aren't just looking at a commodity, we are looking at a force of nature. In late January 2026, we saw silver scream to an all-time high of $121.67 per ounce, only to be followed by a gut-wrenching correction that wiped out billions in paper value in a matter of days. To the uninitiated, this looks like chaos. To the veteran investor, this is just another chapter in the most predictable yet most violent cycle in the financial world. Silver has long been nicknamed the devil's metal because it has a unique way of making you look like a genius one day and a fool the next. But here's the secret. Silver doesn't move randomly. It moves in harmonic cycles. Whether it's the 1980 Hunt Brothers rally, the 2011 debt ceiling surge, or the 2026 AI-driven breakout we are living through right now, the DNA of the silver market remains the same. Today, we're going to peel back the curtain. We're going to look at why silver must crash before it can soar, and why the current $80 to $90 range isn't just a random number, it's the launch pad for the next leg of this secular bull market. If you want to stop being a victim of the cycles and start being a master of them, this is the deep dive you've been waiting for. To understand where we are going in 2026, we have to understand the four distinct phases of every silver cycle. At Signal Scope Markets, we categorize these as accumulation, markup, distribution, and capitulation. Phase 1, accumulation. Think back to 2015 through 2019. Silver was stuck between $14 and $18. The mainstream media called it a dead asset. Retail investors were bored. But underneath the surface, industrial demand for solar panels was quietly doubling. This is the foundation of the cycle. Phase 2, the markup, the breakout. This is the phase we entered in late 2024 and early 2025. This is when the signal becomes clear. Silver breaks its long-term resistance. For us, that was the $30 and $50 levels, and the momentum traders jump in. This is where the price doubles or triples in a year. Phase 3, distribution, the blow-off top. This is what we witnessed in January 2026 when silver hit $121. This is the danger zone. When you see your neighbors talking about silver and high schoolers posting silver stacks on social media, you are in the distribution phase. The smart money is quietly selling to the late money. Phase 4, capitulation, the pain. This is the correction. Silver is a thin market. When people panic, there is no floor. It drops 30% in a week. This is where the weak hands are shaken out and the cycle resets back to the accumulation phase. Understanding where you are in these four steps is the difference between buying the top and buying the bottom. Currently, in February 2026, we are in a secondary accumulation phase following the January peak. The weak hands have left the building, and the long-term structural deficit is taking over again. History doesn't repeat, but it certainly rhymes. Let's look at the Hunt Brothers of 1980. They tried to corner the market, driving silver from $6 to nearly $50. That was a gain of over 540%. But that rally was driven by a few wealthy individuals. When the rules were changed by the exchanges, the infamous Silver Thursday, the market collapsed. Now, compare that to 2011. Silver hit $49 again, but the driver was different. It was a reaction to the 2008 financial crisis and massive money printing. It was a monetary cycle. Now, look at 2026. This is the first time in history we are seeing a triple threat cycle. We have the monetary debasement of 2011, the retail frenzy of 1980, and a new third pillar, industrial necessity. Unlike 1980, the silver being bought today isn't just sitting in vaults. It's being consumed in AI data centers, electric vehicles, and solar arrays. Once silver is inside a Tesla or a solar farm, it is effectively gone from the market for a decade. This makes the 2026 cycle fundamentally more violent than any cycle we've seen before. We aren't just fighting for an ounce of silver, we are fighting for the digital oil of the 21st century. death grip on supply. Let's move past the charts and look at the physical reality of 2026. For decades, silver was a monetary metal with industrial benefits. In 2026, that is flipped. Silver is now an industrial metal with monetary benefits. As we discuss this today, February 24th, 2026, the global silver market is entering its sixth consecutive year of structural deficit. The Silver Institute has confirmed a shortfall of 67 million ounces for this year alone. Why? Because the green transition and the AI revolution have moved from being future concepts to present-day monsters. In 2026, global solar capacity is projected to hit 665 gigawatts. Every single one of those panels requires silver paste to function. While some manufacturers are trying to thrift or reduce silver usage, the pure physics of conductivity means they can only go so far. We are looking at 120 million ounces of silver being locked away in solar farms this year. Then add the AI data center boom. Every high-speed semiconductor and server cooling system being built by NVIDIA and Microsoft right now relies on silver's unique thermal and electrical properties. Unlike jewelry, which can be melted down and recycled easily, silver used in a 5G chip or an AI server is often too expensive to recover. We are effectively consuming our silver reserves at a rate that mining production, which is only expected to grow by 1% this year, cannot match. This is the industrial death grip. It creates a permanent floor for the price that didn't exist in 1980 or 2011.
At Signal Scope Markets, we always tell you to watch the ratio. The gold-silver ratio is the master key to understanding cycles. Throughout most of 2025, we saw the ratio sitting near 80 to 1. But as we entered January 2026, we witnessed a historic compression. As silver rocketed past $94 and touched $120, the ratio plummeted to 57 to 1. This is the lowest we have seen since 2013. Why does this matter? Because a falling ratio is the ultimate confirmation of a silver bull market. It means silver is outperforming gold on a relative basis. In early 2026, while gold was having a fantastic year reaching $4,500, silver was up over 170% in the same period. History shows that in the final blow-off phase of a cycle, the ratio can head toward 40 to 1 or even 30 to 1. If gold stays at $4,500 and the ratio hits 45 to 1, we are looking at $100 silver as the new normal. We are currently in a tactical zone where the ratio has bounced slightly back towards 60 to 1 after the wash correction. For the savvy investor, this ratio bounce is the signal to rotate capital from gold back into silver before the next leg of compression begins.
Why supply can't catch up? One of the biggest misconceptions in 2026 is that high prices will bring more silver to the market. On paper, that makes sense. In reality, it's a trap. Over 70% of the world's silver is mined as a byproduct of lead, zinc, copper, and gold. If you are a copper miner in Chile and the price of silver goes from $30 to $100, you don't necessarily start mining more copper just to get the silver. You are bound by the price of copper. This makes silver supply inelastic. Even with record-high prices in 2026, we aren't seeing a massive wave of new silver mines. In fact, major producers like Mexico are seeing limited growth due to logistical bottlenecks and regulatory shifts. This supply lag is the reason the current cycle is likely to last longer than the 2011 spike. We're in a physical squeeze where the industrial buyers, the Apples and Teslas of the world, are starting to compete with the institutional investors for every available bar in the London and COMEX vaults. The end of price discovery? If you've been following Signal Scope markets for a while, you know we've been warning about the paper game. In the Western world, silver prices have traditionally been set on the COMEX in New York and the LBMA in London. But as of February 2026, the system is fracturing. We are seeing a $10 to $12 premium on the Shanghai Gold Exchange, SGE, compared to the Western spot price. Why? Because in the East, you can't trade promises, you trade metal. In the West, for every 1 ounce of physical silver in a vault, there are over 300 ounces of paper contracts being traded. This leverage worked fine when silver was $20, but at $80 and $100, the shorts, mostly large bullion banks, are trapped. They're using margin hikes to force small retail traders to sell their paper contracts, which creates those scary flash crashes we saw in late January. But look at the inventory. COMEX registered silver has plummeted below 90 million ounces this month. Meanwhile, open interest for the March 2026 delivery month is over 230 million ounces. The math doesn't work. We are heading toward a delivery default scenario where the paper price may decouple entirely from the physical price. If you own physical silver right now, do not let the paper price volatility scare you. You own the real asset. They own a piece of paper that may soon be settled in cash because there is no metal left to deliver.